I'm going to explain velocity banking with respect to credit cards. First question is, does it work? It does. However, it takes many different forms. So this video is going to be really short and to the point, and I'm going to explain it in a simplistic fashion. I have another video I'll link in the description that goes into much greater detail and explains it step by step and actually gives you some tips as to how you can even amplify what you're saving. So the idea behind velocity banking is quite simple. Here's how it works. Let's say you've got $10,000 on a credit card. You're not increasing the balance. That's what your balance is. In other words, you're not charging anything else. You have 20% interest, and the credit card company says you have to make a minimum payment of $200. Okay. So when you make your $200 payment, as you probably know, some of the money goes to interest and some goes to what is called principal. Principal means you're paying down. So the $200 doesn't all go to reduce your balance because there's interest. So here's how the $200 payment breaks out. You have interest of $167 in month one, and the principal is $33. So of your $200 payment, $33 is paying your debt down. So $10,000 minus the 33, 9,967. Okay, that's what you now owe. Next month rolls around, you multiply it by the 20%. You're going to have an interest payment of slightly less. In other words, of the $200, only 166 instead of 167 goes to interest. That's great. That means you now pay down 34 on your principal. So you take your balance, you minus 34, 9,933. You can see how this would just go on forever until it's finally paid off. I have a calculator, which I'll link to as well, which also shows how you can just put in these numbers and see exactly every month where it goes. Okay, so this is the normal situation where you just send in your credit card payment every month. Now, enter velocity banking. How does it work? Here's how it works. In velocity banking, you've got $10,000 balance. The idea is, and let's say, for sake of argument, that you make $5,000 a month after taxes, and you spend, I took out about $2,000 for things that you can't use on a credit card, like rent or a home payment. And then let's just say you spend $3,000 a month. This could be any number. It's still going to work. It could be $3,000, $2,000, $1,500, $3,500, doesn't matter. $3,000. So what do? At the beginning of the month, or as soon as you can, you put your $3,000 and you make a payment on your credit card. So now, instead of owing $10,000 on your credit card, it's $10,000 minus $3,000. So your balance is $7,000. Now you might be thinking, that's crazy. That doesn't make sense. Why would I make a $3,000 payment? I have bills to pay. I got to pay groceries, got to put gas in the car, of course. If you kept it in the bank, you would either use cash from an ATM or maybe a debit card, or maybe you'd write a check. What you're going to do is you're going to move that money by making a payment to your credit card. And now you're going to use your credit card throughout the month. Why does this work? It sounds like you're just spending the same amount of money. You are. But the way interest is calculated is they calculate it on a daily basis. I'm using, for sake of argument, to make this easy, I'm using a monthly calculation. So you simply say, if you're interested, if not, disregard this part. But 20%, 0.2 divided by 12 is 0.01667. We're multiplying that, and that's how we're coming out with the payments. Forget that for a moment. The bottom line is, as you can easily see, if you have a $10,000 balance, 20% interest, you're going to be paying more in interest than if you have a $7,000 balance with 20% interest. So you move the money over, and then during the month, you pay, just like we said, your groceries, your gas, and everything from your credit card. So and I'll explain why it works, but follow me here. Now you have a $7,000 balance. So if you're making a $200 payment, $117 is going to interest and $83 is going to principal. Now you're subtracting that $83 in principal from from 10,000, you'll get 9,917. Then the next month, just doing apples to apples, 115 goes to interest, 85 to principal. Now it's 9,832. Okay, so you can see that in this example, after month one, you owed 9,967. In this example, you only owed $9,917. You paid it down by another $50. You didn't send in more money. I mean, you made a large movement of money, but you didn't pay any more money. It was still a $200 payment. This, end of month 2, 9933, 9832. Okay, why is this working? Here's why it works. Now you can easily see that in this regular method, your principal was going down by $33 and then by $34. In this method, it was going down by $83 and $85. The reason it was going down more is because less was going to interest. Less was going to interest because the interest was calculated on $7,000, not on $10,000. That's it. That's why it works. Now, I should say, let me explain the variable. So now hopefully you understand the method. You simply take your income, move it onto the credit card by making a large payment, and then during the month, you use your credit card to pay for things. The amount of impact that this will have is completely dependent on how quickly you can get your income into pay the card. So you would go online, log in, move money from your bank account over to your credit card. Then you're going to pay your bills. During the course of a month, you want the balance that you owe to be as low as possible. So here's what would literally happen. Let's say you owe $10,000, you move to 3, you now have a balance of $7,000. Then you buy $200 in groceries. Now it's $7,200. Then you buy some gas. Now it's $7,400. You buy some more groceries. Now it's $7,800. You get the idea, because you're still buying those things. So this balance will creep up, back up towards 10. So the trick here is the longer you can delay paying for items like groceries or gas or clothing or whatever you're using your credit card for during the month, the better, because you want the balance to stay as low as possible during the month. Because they calculate it. I did it on a monthly basis just to make it an easy calculation. They do it on a daily basis, right? So during the month, they're going to see, in this method, they're going to see you owe $10,000 every day of the month. 1, 2, 3, 4, 5, 6, the 7th, the 8th, the 9th, the 10th, the 30th. It's always $10,000 times 20%. In the method of moving over, you're going to start theoretically with $7,000. And that might be day 1, day 2, day 3. Then you buy some groceries. Maybe it's $7,400 for day 4, day 5, day 6. So you have interest calculated on 7, then $7,400, onward up. So the longer you can wait in the month to make those payments, the better. And let's just think in reality terms, what's actually going to happen is chances are you get half your money maybe on the 1st and half your money on the 15th, and you move it that way. But the bottom line is, I hope you now understand, velocity banking with a credit card is this simple. Move your income over to the card, use the card to pay your expenses. You will have a lower balance, which means less interest, which means more money to pay off your card, and your balance will go down faster using velocity method on a credit card. I wanted to keep this short. I wanted to keep it simple. I'll have a link to the calculator below, and I'll also have a link to the video, which goes into much greater detail. So if this made sense to you, please watch the other video, because not only can you implement this method, but it'll explain some more tips in terms of timing, and also how you can use things like cashback cards to reduce this even faster without additional income or making larger payments. Thanks for watching. I hope this was helpful.